Hi, can you hear me? Hi, George, can you hear me?
Yes. Good
Cool.
morning. How are you, Michael?
Yeah, I'm not too bad. Thank you so much for coming. I'll just let the other participants kind of open up. Yeah, just that. Thank you for coming. I haven't done this before. Some kind of, it's kind of just, I hope to provide some value. And the way I thought about structuring this is that I'm going to talk for about 10 minutes, more or less, 10, 15 minutes, provide some framework of some companies that you can look at while I'm talking if you want on your screen there. And you can kind of see just what I'm thinking, basically, when I'm looking at this. So, as I said already a few times, I'm hoping to make this really, really simple. And I'm hoping to make this something that I can build on next time. So it's kind of difficult because some people are like Dan in the room. I know he's been an accountant for many years, and he's had his own business. It's kind of he's at a different level of his career and of his journey. So there are different people with different skills, but my hope is to kind of bring everyone down to maybe like a basic level, and then that I can kind of take everyone forward from that point of view. Okay, I'll just wait for Luke to finish signing in, and then Luke, can you hear us?
Yes, I can hear you.
Cool, cool. And Wyatt, can you hear us as well? You just have to say yes or no. Not sure if you can hear us. Anyway, the video is recorded, so we'll just see how it goes. So basically, I was saying at the start, I'm going to talk for about 10 minutes, and then from there, we'll just pick it up, okay? So when I look at any business, the first, before anything like any narrative or anything like that, I'm going to just spend 5 minutes just looking at the balance sheet. And the balance sheet has two aspects to it, has the assets and has the liabilities. The only thing you really need to know on the asset side of the business is just looking at the cash and marketable securities. There will be other things which we're going to discuss in a couple of minutes, but the way that I invest and the way that I recommend that you invest is that you distill everything to quite simple, quite a simple thesis. Occasionally, there are some interesting businesses which have on the balance sheet some asset that could be sold at a profit. For example, BlackBerry recently sold the intellectual properties that they had, and that was carried on the balance sheet as an intangible asset for many years. But for many years, they made it very clear to everybody that there was actually some value within those patents. And they sold them, I can't remember if it was May or something like that. So they sold them for about, I can't remember the figure, it doesn't matter. But that was something that they made very clear. Okay, this is just not some kind of intangible asset. There is actually some value here. So just starting again, if you look at the balance sheet, just focus on the cash and the marketable securities that are part of the current assets. The word current just means that it's going to be used up either within the next 12 months or over the next accounting period. For our purposes, it means that it's liquid, it's real cash. It's a bond or something. So without getting too technical, just spend a couple of minutes trying to figure out. And I've seen many businesses where they have like an interesting story of a turnaround or something, but they have no cash. And if you have no cash, it's gonna be difficult for you to kind of move forward, even if, for example, hypothetically, the business is growing quite fast. An example of this could be a recent IPO, for example. It could be a business that it's growing really, really rapidly, but it's quite unprofitable. So I know that some people in the server's own Sentinel-1, but like this kind of thing. So the business is growing really rapidly. It's quite unprofitable. They haven't quite figured out yet how to become a profitable endeavor. There's a lot of appetite for their offering, not just talking about Sentinel-1 here, but I'm just kind of in general. So the business is growing really rapidly, but they need capital. And if you don't just spend 5 minutes to look at the cash aspect of it, it just defeats the whole purpose, okay? On the other side of the equation, sometimes you will have a business, for example, something like Context Logic, which is a commerce business, that the market cap is approximately 150 million, and they have somewhere in the ballpark of, let's say, 350 million in cash. So that's interesting, right? That put kind of an anchor on the market valuation, because people are not going to be really selling very aggressively a business that has a lot of cash and no debt, okay? So that's the cash side of the equation. Now, the examples that I've picked out here, so I'm going to talk about Snap. And so I've picked out two businesses that, in my humble opinion, are not exactly doing quite well at the moment. They kind of hit a bit of a rough spot. I've written about them extensively, so my views are quite well known. I am quite bearish on these two companies, but I highlight them both to explain that there's a bit of nuance, and sometimes it's difficult to discern nuance when you know, the share price is going down, and it kind of, how I describe it, it kind of causes that mist in your eyes. It's kind of like the share price is going down, it kind of confuses people. People kind of get, oh, you know, if the business is dead, they're dead. So in the case of Snap, it has approximately, between the cash and marketable securities, approximately 3.5 billion in liquid cash, okay? So it has some goodwill, which, you know, goodwill typically isn't asserted a lot of value to, but I gave you some examples. Sometimes there is some value there, and I gave you the example of BlackBerry. You can look that sometimes that goodwill or those intangibles can have some value, okay? And then on the other side, now we're going to talk about the liabilities. So the liabilities, there is really no question marks there, because that's money that you owe to people, okay? And they will come after you. So with the asset side, you just need to focus on that one line, which is the cash. On the liabilities, you need to spend a couple of minutes to go through it. Now, there's some shortcut here. The shortcut is you just look at how big a proportion the liability figure is relative to the total assets on the balance sheet. So, for example, let's say for round figures that the total assets are 3.5 billion, just pretend round numbers, and the borrowings or the convertibles or the notes are approximately 3 billion. So there you kind of tells you, okay, this is quite a large proportion of how those assets have grown, have been from taking on some type of external cash, be it, in this case, we're talking about debt. So you just, that's the shortcut. You just look at how big the number is relative to the total assets of the business, or it can be the total liabilities, because they kind of match up mostly, particularly in software businesses. Now, so when you look at a business and it has, let's say, in this case, a Snap, 3.5 billion in cash, and on the convertible side, it has approximately 3.7 billion. It's kind of matched. That gives the business time to turn around its efforts, okay? Because the business may or may not, in the case of Snap, it is an unprofitable business, but, you know, there are, when I refer to unprofitable, I mean in a GAAP sense, that including stock-based compensation. So the business can do something, okay? So it has enough cash and the liability sides match each other. So it's kind of, let's say, what people sometimes refer as a net neutral. So net debt neutral, that the debt and the cash balance each other. So business can do something. It can, you can have enough cash to reinvest back in the business. Now I'm going to provide a different example. So the other example that I came across recently is Farfetch. Farfetch is a business many of you will know. It's an e-commerce business in the luxury sector, and the business in this case, has approximately 450 million of cash on the balance sheet. So I just spend a couple of minutes, I look on the cash side, and I see 450 million. And then I just glance down and I see that they have a substantial inventory, which pretty much matches the cash side. So you think to yourself, okay, a lot of the wealth of this business is tied up to the inventory that they hold. Now, how much value does that inventory really hold? It's quite seasonal, right? It might be around for, let's say, this next 6 months, but the value of luxury items kind of erodes quite quickly. It's not like, for example, that you have a commodity, let's say gold or whatever, it's going to erode quite quickly. So spend a couple of minutes, just look at the cash side. Then you look over and you say, okay, it has approximately 1.5 billion of intangibles. Intangibles is when a business, particularly a software business, is capitalizing their earnings. I don't want to make it too difficult on this occasion. I'll just tell you, just look and you see that there's a lot of intangibles, and you see the intangibles on the balance sheet are worth 1.5 billion, but the market cap of the company is approximately 1 billion. So then that tells you straight away, okay, the market isn't asserting a lot of value onto those intangibles. So the market is telling you, okay, those intangibles don't have a lot of worth there. So you continue to go down and you moved on to the liability side of the business. And you see that the borrowings that the business has are approximately 900 million. So they have twice as much borrowings as they do have cash. So for every $1 that they have of cash, they have $2 worth of borrowings. So that tells you straight away that it's an unequal balance sheet. There's some kind of restriction there. In the case of Farfetch, it also has approximately 400 million of financial derivatives. Now, the way that I recommend that you look at a business is that you don't try and get too kind of bogged down and caught up in how long until the debt is due, but I'm going to try and provide this kind of thought process either next week or the week after, and I'm going to kind of give you some more shortcuts, kind of how you can look to see when the debt is due. And so, you know, if the debt is due, for example, at the end of the decade, it's one thing, and if it's due in the next 3 years, it's quite another thing. So, for example, let's say that the debt is due in 2 years' time, okay? You, as a CFO of the company, you want to get ahead of that debt maturity. You need to do something to kind of start motivating some type of debt refinance of some sort before that becomes due. So you want to see, or the language in the earnings call, you want to see that they're trying to get ahead of it, they're trying to tackle it, and these kind of things are not too difficult once you kind of get used to it, but I'm going to talk much more about that next week and then the week after. So from my perspective, just to summarize, and then I'm going to open it up to some Q&A. So from my perspective, I believe that these 5 minutes that you spend looking at a balance sheet are worth a lot of money. I think that the returns that you can make can really be facilitated by having a clean balance sheet. Because if you have a balance sheet with some problems, I'll give you a different example because it's fresh in my mind. I wrote about Skills, the company, on Friday, and I did this example, what we're just discussing right now. I kind of go through and I kind of say, okay, there's some problem here, and I kind of highlight it on Friday. Okay, they're probably going to have to raise some debt, and everything that I've just discussed here with you right now, I explained there, and then I can't remember the day of the week we are now, Tuesday. I think it was Monday night. On Monday night, they said, actually, we're going to have some kind of capital raise or share repurchase program. So management is trying to get ahead of that debt maturity, and they will often phrase the capital raise with what I call distractor information. They kind of talk about share repurchases, so they don't want to kind of spook anyone. They don't want to highlight that they got a liquidity crisis, because obviously your shareholders are just going to run out the door. So you need to be quite used to how companies phrase certain things, but the examples that I'm providing you right here, you don't need like to have like an MBA or whatever. It's just 5 minutes. Spend 5 minutes, you look through that, you kind of just tick a little box. And just to conclude, I often recommend to you guys your own investments and just write 3 bullet points of what, whenever you buy a stock, just write 3 bullet points. Don't talk about the valuation. That doesn't really matter. You know, if the business is going to do well, it will take care of itself. But just write 3 bullet points and just put a little tick for yourself. Say, okay, I've looked through the balance sheet. It's taken me a few minutes, and I feel relatively satisfied that there is not something that's going to strangle my business from turning around. So I'm going on a little bit, but I just wanted to conclude this. So in the 2 examples that I provide with Snap and Farfetch, in my humble opinion, both these businesses could turn around, but I believe that Farfetch will struggle to turn around simply because they have so many creditors coming after them that, you know, it's going to restrict your flexibility. Your business, in this case, Farfetch's business, has to think long and hard how they basically reach profitability very, very quickly. And if you're trying to reach profitability too quickly, it disrupts the experience of the user. So it's just not a good position. Now, I'm not a Snap bull by any chance, but I believe this business will still continue to do quite well over the next 3-4 years. But just because they have time, you know, you can weather the storm. Everybody that follows ad tech, advertising stocks, will know that, you know, they've kind of hit the rough patch last 2 years. A lot of advertising companies have really struggled. This is a cyclical industry, and, you know, it will turn around in time. It's just that you need time. And in the case of Snap, they have a clean balance sheet for all intents and purposes. So they will manage to do so. And I'll just say one more thing, because it just in the fresh my mind. What I believe Snap has done that hasn't been too astute has been to start using the capital that they have, the cash that they have on the balance sheet, to repurchase their shares. But that's a different aspect, you know, that's a whole different discussion. But the point that I'm trying to explain is that position yourself in a business where you're allowed to have some staying power. So I don't know how that was too superficial or whatever. If, like, you guys can kind of maybe ask some questions and answers now.
Maybe I start.
Sure.
I always have a bit of confusion about the gap and the non-gap earnings. Like, when do I look at it and when do I not look at it?
So it depends on the business, okay? So I'm not a fan of this, but typically smaller businesses, investors are more inclined to give them the benefit of the doubt. And I don't decide this, but the non-GAAP metrics for a smaller business tends to be a reasonable proxy of how the market will look at it. So I'll give you an example of this. So it's not a business that I'm particularly bullish about, but it's done very well. Netflix. For a long time, people were just looking at Netflix on a non-GAAP basis, but about 5 years, or maybe it was 4 years ago, I can't remember now, they kind of started becoming GAAP profitable, and investors became more kind of willing to appraise it on a GAAP profitability level. You can take this forward and you can look at, for example, something like Google, something like, Alphabet, something like Meta, where people kind of tend to look, if it's not an abnormal quarter, people tend to kind of have a gauge on the GAAP level. So as a rule of thumb, smaller cap businesses, you tend to kind of look in that way, because the idea here is that as the business matures, you will be able to take out some of that layer of R&D and sales. Now, I don't believe that to be 100% true, because no management team will ever shrink their business. It just doesn't happen. But the market historically, over the last 20 odd years, has priced things like this. So rather than me reconstructing or rebuilding the wheel, I'll just say, okay, this is how it has worked, and it should continue to work like this. It's not a perfect mechanism, and it's not that, you know, I'm not a fan of that, but it is what it is.
Michael, I have a question. You were talking about liabilities and assets. Is it now? I've been doing stocks for many years, but I'm still a novice. Can I just look at the total assets and then the total liabilities? Is
No.
it that simple just
No.
to say, okay, that?
No. You can pretty much, for most businesses, forget about the long-term assets of the business, because the long-term assets of the businesses is a question mark. It's an accounting estimate made by someone what it could be worth, okay? What you were interested in is just looking at the current assets. That's things that will be used in the next 12 months or less. So, you know, so I gave this quote before that you need to kind of, you need to be quite skeptical of any business. I gave this quote, and I'm you know, it's a bit nasty to say this, but Charlie Munger often says about CEOs when they're talking, they're lying, and when they're quiet, they're stealing. And it's basically, it's an estimate. So a business wants to demonstrate to you the best value, the intrinsic value is quite high, but it's an estimate. You don't know how well the business is going to do. Again, let's go back to Snap. Snap had an investor in 2021, 2 years ago, where they said at that time, we estimate that from today onwards, for the foreseeable future, we're going to grow our revenues at 50% compounded annual growth rate. And basically, from pretty much that quarter onwards, their growth rates has just decelerated, and went into negative territory. So it's difficult to make, like that quote to Yogi Berra, it's difficult to make predictions, particularly about the future. So I don't give any value to the assets side of the business, apart from when you know that management has told you there is someone looking to buy a portion of our business, or, for example, it's not a business that I own, but for example, Shopify says, okay, we have some investments, equity investments in other businesses, or Alibaba, where they take a proportion of the equity of other businesses. So those are publicly traded businesses. But I would, unless you have to, I would recommend that you don't add that layer or to your investment thesis, because that's really kind of double counting, because just operate with as much margin of safety, make it very, very simple. So just to say this again, some businesses will have as on the long-term assets of the business some equity on publicly traded companies, but from the majority of businesses, just look at the cash side. Now, on the total liability side, that is worthwhile. You could take that figure. Now, the only thing that I would really look to exclude from the total liability side are the accounts payable. Accounts payables are what you owe to your partners. Those can kind of fluctuate quite a lot from quarter to quarter. Like if you're having to pay, for example, if it's the season, if you're an e-commerce business, when you hire it and you're buying a lot of stuff, a lot of inventory, you may have taken on some kind of very short-term credit notes from the partner that you bought from, and that will swing next quarter in the other direction. So, but just to make it simple for yourself, just look on the total liabilities, take that at full value, but just focus on the current assets, predominantly just the cash, really.
Okay, thank you, sir.
Luke, this is your chance. Luke, I think you're muted.
Yeah, I think you already answered the question that I had, but that was on the liability side. So on the asset side, you say, look at the current assets better than looking at the long term. But on the liability side, what you're saying is we should look at the total liability, not just the current liability, right?
Absolutely, absolutely. And my goal is either, I don't know if it's going to fall into the next week or the week after, I'm going to show some kind of quick ways of us looking on those liabilities and get a sense of really what is what, because sometimes those liabilities can be like in the case of Amazon, you can see the or IBM, those liabilities will be after I'm dead, they'll still be like the maturities are still coming out, or Berkshire Hathaway, for example. So I can kind of show like some tricks for us to kind of just within 5 minutes or even less look at and understand what is really the figure. But I believe that that is just adding some more complication. But I'm going to help you and help you think about that anyway. But I'm just trying to kind of give you some practical help that that to get everyone on the same level, and then we'll kind of take it from there. Does anyone else have any other questions they'd like to ask?
Very quickly, what is FCF? You wrote up an article and you said
Oh, I
Stan X
apologize.
FCF. What
I apologize.
FCF?
So that's free cash flow. So
Thank you.
so the way, so definitely this is, I wanted to spend a bit of time when we kind of do a more advanced level. I'm going to talk a lot about free cash flow, but I'll just explain it to you really quickly right now, and then we're going to go and do some interesting things. I have to kind of, I want to pick up some kind of, I like to pick up some kind of current examples of some stuff that I see, because I have over time seen some interesting, like where they kind of do some financial shenanigans, and it's kind of more fun and more interesting when you kind of look at this company, they reported last quarter, look how they've kind of double counted on BlackBerry. Yeah, we're gonna do that on BlackBerry. So basically, we're gonna go through this and show how you can see, okay, the business the free cash flow isn't really what they're showing it is. But here's how you think about free cash flow. So a business will make revenues and it will have a lot of costs to do with incurring those revenues. And you end up with what is termed cash flow from operations. So I'm not going to make this too difficult at this point. We're going to dig that in. We're going to kind of speak about a lot more about that in later on. But so a business will have revenues, and from those revenues, will have a lot of costs. And once you end up with it, you get rid of the costs, what you're left with is cash flows from operations, okay? So a business, for example, if you're a CapEx heavy business, if your business is very capital intensive, you're going to have a lot of CapEx. For example, Albemarle, so if it's a mining company, has a lot of CapEx. For example, if you're Amazon and you're having to build out your AWS, your cloud business, you're going to have a lot of CapEx. So that CapEx, you subtract, you take away from the cash flows, and you end up with what's called free cash flow. The free cash flow of the business is what you, as the shareholder, get to keep. So the business may think, okay, I prefer to reinvest in my growth. So for example, this would be Amazon's case, they're reinvesting for their growth. You can look for other businesses where they say, actually, we believe that our best use of cash right now is to acquire more businesses. For example, this would be AppLovin that I wrote about today, is a business that certain businesses don't really want to spend too much capital reinvesting in themselves. They prefer to just acquire a business intact. So an example, the classic example of this would be Berkshire Hathaway. So Berkshire Hathaway makes a lot of free cash flow, and they don't really reinvest in themselves. They just go out and buy somebody. In the software side, there's a business called Constellation Software, where they also think, and they explain this at length, that rather than their software side, but rather than them reinvesting into their operations, they believe they might as well just buy a business, because when you're buying a business, what you're doing in its essence is you're acquiring customers. So it's a customer acquisition strategy. So certain businesses would prefer to invest in themselves. Some businesses will prefer to acquire other businesses. Some businesses may prefer to pay out a dividend. So you have one OKE, which is one of the dividend stocks that I have in the service. They say, okay, we're just going to keep paying out a substantial portion of our free cash flow as a dividend. So they kind of pay out a 6% dividend. So there's different ways you can reinvest that free cash flow. But for our purposes, it's really the cash that you, as the owner of the business, are entitled to do. So let's pretend, for the sake of our discussion, that you have you own more than, let's say, 40% of the business. You can say to the board, actually, board, I don't want you to reinvest any more cash because you've shown that you cannot really reinvest that cash successfully. Not to pick again on BlackBerry, but just because it was on top of mind. So BlackBerry has in the past made a lot of acquisitions in cybersecurity, and they just basically buy them, and then 12 months later, they just write them off. So they have shown that they're not very successful at acquiring businesses, and they end up just writing them off. So that's cash that you could say, if you own 40% of, or I don't know, a certain portion, or even 5% of BlackBerry, you could say to the board, I believe that you are squandering the capital that is mine as a shareholder of the business. Let's give out that cash as a dividend. So the free cash flow is really the tangible cash flow. It's many investors like Warren Buffett and others really look towards the free cash flow of the business rather than the earnings. So Buffett has this kind of joke that came out at the Berkshire meeting this year, where he calls that the way that Wall Street sees earnings right now is what they call, it's not EBITDA, it's EBE, which stands for earnings before everything. So it's a joke, but essentially means that everyone is just accounting for these earnings, these fictional earnings. But he says, just look at the free cash flow of the business. So the free cash flow of the business is actual cash that you can do something with, because there's not a lot you can do with earnings. Earnings are an estimate made by accountants to what the value can accrue to the business over time, but it's just an estimate, okay? So you, as an accountant, you can come up with an estimate of what your quarterly earnings should be approximately next quarter. Now, that would not be like doing something that is, that would not be like illegal or false, or you can say, okay, I believe it should kind of in the ballpark of this, because we are estimating that the servers that we hold, like Google did, not this quarter, I think it was the quarter before, they say actually we have been too aggressive in running down our servers, so we believe the lifespan of our servers is going to last longer, so we don't need to be as aggressive depreciating the servers, so it improves the earnings that they make. But you can't improve the free cash flow of the business, right? The free cash flow is the cash that the business makes.
What's a good number for a free cash flow?
So it
What's a good number?
It very much depends on the business. So some businesses, for example, something like Costco, they may only have, I'm not very familiar with Costco's business model, but I suspect they probably have around 2 or 3% free cash flow. So something like Walmart and something like Costco would have approximately 2% free cash flow margin. That's free cash flow divided by revenues. But something like, say, like Meta, for example, could have free cash flow margins of 40%. That means for every $1 that they make, 40% belongs to the owners of that business. So that's a very free cash flow generative business that produces a lot of free cash flow. That's why Meta is such a valuable company. I suspect that Microsoft will probably have around 32, 33% free cash flow margins. So these are what a lot of the tech businesses aspire to one day be. Now, realistically, this is kind of probably may get into complicated, but a large portion of tech's free cash flow is stock-based compensation that gets added back. And I'm going to talk about that much more next time. But I hope that this kind of provides some kind of framework for people to think about.
Thank you.
Does anyone else have any other questions?
Yeah, if I may ask.
Yeah, sure, go ahead.
regarding the cash and debt, because I find that sometimes in a way cash also may be an estimate, because if the company has operations worldwide, so naturally it has cash in all different currencies, same with debt, and these currencies may fluctuate against US dollar or whatever. So do you know any good way to check, when you said you look at cash and debt in the balance sheet, but do you do it like you check every 3 quarters, for example, to see if there is a consistency between these metrics, or you see some strange moves not explained by free cash flow or something like it?
So I will give you the short answer that if you trying to figure out to that level of detail whether the cash is there, I personally would not get involved in that business. Now, cash is cash. You can look up, you can on Friday evening, you look up, if you're the CFO of the company, you just get in touch with your software, you look up Friday evening, the cash is typically held at a few different banks, and the banks will just tell you straight away how much cash is there. There is no ambiguity. Cash is cash. Now, occasionally, I take your point that there is certain businesses where it fluctuates from quarter to quarter, but for all intents and purposes, that may be hedged out. So, for example, if the business has a lot of cash, let's say in Nigeria, for example, they would, if it's a reasonable company, they would hedge out that risk. So what you see is pretty much what you get.
And that's a great answer, really.
Thank you.
Thanks.
Okay, I'm going to wrap it up here. Thank you so much for coming. I hope that this has been helpful. If you can give me some feedback either on the chat or privately, and I'll try and take it on board and make it better for next time.
Thank you.
Thank you.
Bye.
Thank you.
Thank you.
Thank you, Michael.
Thank you.
Thanks, bye.